In today's episode, I'll talk about two interesting stories. In the first one, I'll talk about how India's pharma outsourcing giants like Divi's and Akums are quietly powering the global drug industry. And in the second story of the day, I'll talk about why India's manufacturing sector is struggling to compete globally and what it'll really take to fix all of it. Welcome to the Daily Brief show by Zerodha, where our aim is to cut through the noise and simplify the biggest news and stories in the financial markets in a way that is easy for all of us to understand, yet one level deeper as compared to your traditional news channels. I'm your host Anurag Bansal, and today is Friday, the 30th of May. So what we're looking at today in the first story is one of the most fascinating corners of India's pharmaceutical industry, which is a segment that most of us never see, but it is becoming more and more important as time progresses. This is the field of contract development and manufacturing organizations, which are also called CDMOs. Now I know that sounds very complicated, but don't worry, I'll break it down simply and slowly for you all. See, most of us think of pharma companies as the ones who just invent new drugs, get approvals, and then sell those drugs under their own brand names. And yes, of course, some companies do all of that, but the thing is, behind all of those brand names there is an entirely different kind of business which is at work, which is one that does not invent new drugs, does not run big marketing campaigns, and does not sell anything directly to consumers, but instead it develops and manufactures drugs for other companies, quietly working behind the scenes of sorts. That is exactly what a CDMO does. You can think of them as back-end service providers for the pharma world in some sense. They are specialized white label manufacturers, which are the kind who will make something on the behalf of somebody else without really putting their own name on it. But because it's pharma, the complexity involved is a whole different level here. The companies are not just running basic factories, they are handling a mixture of science, safety, and regulation, and they are doing this at a global scale. Now this space is growing really fast. In fact, it is evolving as well. Today, a lot of these CDMOs are expanding into something that is called CRDMOs. Now the R here stands for research, and that very tiny change here is actually quite a big deal. It means that clients are not just asking these firms to manufacture drugs, but they are also asking them with early stage research and development as well, which is basically outsourcing the bottlenecks of innovation in the first place. And that is a very big shift, and India is in a great spot to benefit from all of it. You might be wondering, why is this model even getting popular in the first place? See, globally, big pharma is under huge pressure. Their research pipelines are drying up, R&D costs are going up, and many blockbuster drugs are now coming off patent. That basically means that companies are suddenly looking for more ways to save money, to move faster, and also to reduce risk. And outsourcing their jobs to CDMOs ticks all of these boxes that they are looking for, especially if you're trying to reduce dependency on China, which by the way is a growing trend after all the supply chain shocks in the recent years. India becomes a very attractive alternative. And the thing is, unlike a lot of other kind of contract manufacturing, pharma's CDMO work is not a low cost commoditized game. It is actually a high trust, high stakes business to quite a great degree. I mean, think about it. You can't just randomly one day wake up and set up a plant and call up Pfizer or Novartis, right? Getting into this ecosystem itself takes many years, and before any major pharma company gives you a contract, they will likely spend 2 to 3 years even auditing your facility, running trial batches, and even checking every single process that you follow. And only once they are convinced and you are into their system, the relationship becomes sticky. But of course, getting there takes time, credibility, and some serious amount of investment. And apart from that, what also makes this work difficult and also valuable for that matter is that it's not just about capacity, it is about reliability. It is about making sure that the product is exactly right every single time, because even the smallest mistake in a drug batch could have massive consequences. You can imagine that very well. And that is why compliance is absolutely everything in the pharma industry. Regulatory bodies like the US FDA or the European Medicines Agency are constantly scrutinizing CDMO plants. Any misstep whatsoever can shut the entire facility down. And then there is also the technical complexity aspect of it. For instance, scaling up a drug from a lab to a full-scale factory run is not really simple, as you can imagine. It's not just about making more of the same thing. You have to ensure that purity, yield, consistency, and cost efficiency, all of it stays intact as the scale grows further. And finally, there is also currency. See, most of these businesses earn in dollars or euros and then they spend in rupees. Now, of course, that's good if the rupee is weak, but if the currency swings or shipping gets disrupted, it can really create real stress on margins and working capital. Now, within this high-stakes world, two Indian companies have taken very different different paths here, and both of them are making some good moves here. One is Divi's Laboratories and the other is Akums Drug and Pharmaceuticals. Let me talk about Divi's Laboratories first to give you a quick understanding of what's exactly happening. See, Divi's Laboratories is one of the most respected names in the global pharma supply chain. They don't make their own branded drugs. Instead, they actually support some of the world's biggest pharma companies by manufacturing complex ingredients and intermediaries that go into patented medicines. Now, this is deep technical work, and Divi's has basically built their entire reputation on doing it correctly every single time. Their business has two major parts. The first one is their custom synthesis division, which is their real gem. Big pharma companies outsource very specific parts of their drug manufacturing processes to Divi's, especially for complex or patented drugs. Now, this division alone brings in more than half of their total revenue. Then there is also that generics division where they make widely used off-patent molecules and sell them in bulk to formulation companies. That is about 45% of their entire revenue. Then they also have early stage bets in high growth areas like peptides, contrast media and nutraceuticals as well. Now, to give you a quick sense of the numbers as well, in the last quarter, Divi's posted a revenue of about 2,600 crore rupees, which is around a 12.1% increase from the same quarter in the previous year. Their profit after tax or PAT was around 660 crore rupees, again up by around 23%. The question is, what's really driving their performance? See, the biggest factor was a new long-term contract that they signed with a major global pharma company to manufacture an advanced intermediate. Now, that term basically refers to a chemical building block that goes into an unfinished drug. And the fact that Divi's is able to handle this kind of complex work means that they are likely making inputs for a patented high-value medicine. The contrasts are very rare. They usually take years of vetting and validation to land, but once it is signed, they give you revenue visibility for many years and often come with very strong margins. And that is a very big deal. Anyway, another area that Divi's is betting big on is peptides. To give you a very quick explainer, these are short chains of amino acid which are larger than chemical drugs and smaller than biologics, and they are being used in some of the most promising therapies in the world today. Drugs like Ozempic, Wegovy, etc., which are used to treat diabetes and obesity, are peptide based itself, and the demand for this class of drugs is right now skyrocketing, as you might have imagined by now. Now, to give you a reference, Divi's has been in the peptide game for nearly 2 decades now, but what's different is that they are now moving up the value chain from simple amino acids to full-blown peptide APIs. Now, that is a smart, margin-rich bet for the future. Then they are also entering the contrast media segment. These are basically injectable compounds which are used in medical imaging like MRIs and CT scans in order to help highlight some parts of the body. It is a very niche and a very heavily regulated segment, but the margins here tend to be slightly on the higher side. Not many Indian players operate in this space, so Divi's early move here could really give them a very strong head start. But that said, not everything is good here. Divi's generic API segment is under some serious pressure. Prices are weak and China is sort of flooding the market with some cheap supply. But again, Divi's has managed to hold on to its market share by being cost efficient and also reliable, which are two things that really matter in this business. On the infrastructure side, Divi's has a new facility which is vertically integrated, and that basically means that they can now produce their own key raw materials, which gives them more control over quality as well as on cost. And that is important, especially in times of global disruption. And speaking of disruption, logistics has been a huge challenge here. The Red Sea crisis last year forced cargo ships to reroute, which added weeks to delivery schedules. Divi's though stayed on top of it. They pre-booked container space, worked closely with logistics partners and improved real-time shipment tracking so that they could avoid delays. And therefore, they did not also report any missed deliveries, which is quite impressive considering 90% of their sales come from exports itself. Anyway, now let's move on and switch to Akums, which is a very different player as compared to Divi's. See, while Divi's is a global giant which is focused on ingredients and custom synthesis, Akums is more like the quiet engine of sorts of India's domestic pharma industry. Now, I know you might not have really heard their name, but you have almost certainly consumed a drug that they have manufactured. And that is because Akums is the manufacturing partner for hundreds of branded generic companies across India, especially those that dominate prescriptions in smaller towns and cities. They operate 11 plants and offer more than 60 dosage forms. In FY 2025, their domestic CDMO business alone brought in over 3,200 crore rupees, which is nearly 78% of their total revenue. Now, their business model here is pretty straightforward. Branded generics companies outsource their manufacturing to Akums while they focus on sales, marketing, and building relationships with doctors. But the thing is, Akums does not just make tablets. They also help companies develop new formulations, they manage regulatory approvals, and also conduct research and development. To give you a reference, in FY 2025 alone, they invested 130 crore rupees in R&D and they launched 31 new products which were approved by India's drug regulator DCGI. As a result, over 20% of their portfolio now comes from niche or complex products, which typically bring in better margins and also create stronger client stickiness. Talking about numbers specifically, in the fourth quarter of FY 2025, Akums reported revenue of 1073 crore rupees, which is up around 12.5% from the previous year. But that number hides a few underlying dynamics as well. See, because Akums work on a cost plus model, which is where raw materials cost are passed through to clients, their revenues can fall even when the volumes really go up. And that is exactly what has happened this quarter. API prices, specifically for certain drugs, fell quite significantly. So while Akums may have made and sold more, their top line did not fully reflect that change. Margins were also fairly down. Their EBITDA margin dropped to 10.6% in quarter 4 from 11.1% last year and much lower than 15.4% in the third quarter. Now this drop is mostly due to two things. First, the product mix itself has changed. See, high margin injectables and complex formulations made up a smaller share of sales, while simpler low margin tablets became more prominent. And that shift seems to happen every fourth quarter, possibly due to client stocking patterns. The second thing is that quarter 4 also includes employee bonuses and annual costs for them, which sort of inflated their expenses. But that said, this is not a structural concern as such as you may have imagined. In fact, Akums is setting itself up for stronger future margins right now. They recently opened a new injectables facility which will produce complex products for them. And these particular products come with better pricing power. But since regulatory approvals and client validations take some amount of time, the revenue has not kicked in yet for them. But that said, things are moving. The plant has already been audited by Brazil's ANVISA and European audits are next. And once that gets cleared, Akums will begin fulfilling a massive 200 million euro supply contract with a European pharma company, which is a deal that marks its pivot into global markets. But like everything else, there are a few pain points here as well. See, Akums' trade generics business, where they sell under their own brand, is struggling right now. It's a small part of their business for sure, but it posted a 10 crore rupee loss this quarter. They have already said that they are consolidating here and they may exit altogether from this. Their API division also continues to post losses, although they have narrowed slightly this particular quarter. But still, the larger picture here is quite clear. Divis and Akums are both riding the CDMO wave, but from very different positions. One is a globally respected partner for complex molecules, while the other one is actually a domestic powerhouse of sorts, which is helping India's generics engine run very smoothly. Both are adapting, both are investing, and also positioning themselves to benefit from pharma's ongoing shift towards outsourced innovation. On that note, let's move on and talk about the second story of the day. See, India has recently become the world's fourth largest economy, overtaking Japan. That is a big headline that has been doing rounds in the news and everywhere else recently, and I'm sure you've also heard about this. Government think tanks like the Niti Aayog have mentioned this as a major milestone for our country, and for sure it is a major milestone, no doubt. It means that when all of us now as a country show up on the global stage, we now command more influence than we ever did before. Our combined GDP is slowly climbing up the ladder and the world is paying more attention. But like everything and always, there is a twist here. See, if you zoom out for a second and you look at what this really means, the picture is not as straightforward. Yes, the overall economy is now bigger than Japan's for sure, but what we need to remember is that India also has a population that is more than 10 times the size of Japan. So when you divide that GDP by the number of people, our average income per person, which is what economists call per capita GDP, is still extremely low. And on that scale, to be honest, we are currently sitting in the same zone as countries like Angola and Kyrgyzstan, not anywhere close to the world's richest or even mid-tier economies for that matter. In fact, something very important that most people do not realize is that India was one of the world's top 10 economies way back in the 1960s as well. So while this new milestone is definitely a feel-good moment for all of us, the truth is that it's not really the first time, and it does not automatically mean that we are on the verge of becoming a very rich country. If anything, it's actually a reminder that for all our progress and potential, we still might be underperforming really. And that basically brings me to the uncomfortable truth, which is one that we all sort of know deep down. See, as an economy, India is still punching below our weight. We have the size, we have the population, we also have the talent, but something is not clicking for us. One major reason possibly is that how we've handled trade, especially in the area of manufacturing. Let me take you through the numbers first. See, in 2023, India contributed just 1.9% to the world's total manufactured exports. That is a very tiny share for a country of our scale and size. To give you a comparison, Vietnam, which is a country that's only 5% our size in terms of population, shipped almost the same amount as us. In fact, when it comes to exports to the US, Vietnam has now left us behind. To give you context, back in 2018, both our countries exported around $46 billion worth of manufactured goods to the US. But by 2023, Vietnam had scaled that to around $113 billion, and India was just at $74 billion. So in these 5 years, Vietnam was actually quietly climbing the ranks, signing trade deals, improving infrastructure, and locking itself into global value chains. It's kind of sad that while on one hand we were supposed to become the world's next great manufacturing hub, but instead what we're doing is just watching others take that place right now. The truth is that if we really want to go in a real and meaningful way, not just on paper to be honest, we need to face this problem head on. And when you dig deep into that data, you will see that this is not just about one or two policy mistakes, it's actually a much deeper structural problem. See, our manufacturing sector is not just underperforming, it's actually shrinking at this point in time. Back in 2015, manufacturing made up 16% of India's GDP, but today that figure is down to 13%. In a developing country like ours, that to be honest is a little bit alarming because manufacturing is actually supposed to be the engine of sorts that drives both growth and job creation. Now, a recent paper by a group of scholars at the Center for Social and Economic Progress tries to explain what's exactly going wrong here. But instead of simply listing out the usual problems, which is land issues, power shortages, rigid labor laws, etc., they approach it a little bit differently. They ask a slightly smarter question, which is what do successful manufacturing countries actually do right, which India can really take a look at? And to answer that, they lean on a well-known model from Harvard professor Michael Porter. He created something that's called the Diamond Model, which is a framework that looks at 6 key areas that make a country competitive in global manufacturing. Now, these include basic inputs like skilled labor and power, the quality of local demand, the strength of supply chains, how competitive local businesses are, the ease of regulation, and how well the country is plugged into global trade networks. Now, these researchers basically tweaked this framework slightly to make it more relevant to India and then used it to compare India with 4 other Asian countries, which is Malaysia, Vietnam, Thailand, and Indonesia. Now, the reason why these 4 countries are important is because they are not countries that we usually think of as being far ahead of us. But honestly, the results are a bit sad. India really comes last here. The only area sort of that we do well is domestic demand, which means we have a massive internal market. And that gives our businesses a large customer base to sell to and theoretically creates an ideal testing ground for firms to scale and also become globally competitive. But that honestly alone is not enough because across the other areas, which is actual conditions that help businesses grow and compete, we really fall short of everyone else. Let's take labor as an initial example. See, usually we intuitively think of India having a labor advantage because we have so many young workers. But the thing is, when it comes to productivity, that is how much value each worker creates, we are really at the bottom of the group. An average Indian worker produces goods worth about 8.3 US dollars per hour. But in comparison, in Malaysia, that number is over $27. So even though we have more people in numbers, we are getting much less value from each one of them. Anyway, let's now move on and look at capital and land as well. See, Indian businesses struggle to get access to both of these. Land records are generally messy and they are hard to navigate as well. And of course, credit is difficult to access, especially for small and medium businesses. And basic infrastructure like electricity, water, and transport continues to fall short as well. Then there is another issue of supply chains as well. See, every business depends on inputs, which is raw materials, parts, machinery, and whatnot. And if these are expensive or they are hard to get, then the final product also becomes uncompetitive. Now, unfortunately, India's tariff system adds to the problem as well. On an average, we impose a 15% tariff on intermediate goods, which are things that are used to make other goods. That is 3 times what Malaysia charges, and Vietnam, which is our key competitor, charges just 5.8%. Now, the context here is that these tariffs essentially act as invisible taxes of sorts. They raise the cost of raw materials and they slow down imports. Now, this hurts industries like textiles and electronics, where our input costs are way higher than our rivals. Let's say a garment manufacturer wants to use a polyester yarn. If they import it, they end up paying a 20% tariff. Now, that adds about 10 rupees per kg. And this is one reason why Vietnam dominates the global synthetic garments market with a 35% market share, while we remain stuck at below 5%. And it's not even that. In electronics, the story is exactly the same too. We've placed high tariffs on display panels, circuit boards, and other key parts. So even though we are trying to attract big companies like Apple, for example, our policies honestly make it slightly harder for suppliers to cooperate here. Anyway, another major issue here is also the competition, or maybe the lack of it in some cases. See, in India, a few large players dominate entire sectors, especially when it comes to raw materials. These upstream companies usually benefit from policy support and do not really face much competitive pressure. And as a result, prices stay high and efficiency ends up staying low. And even apart from that, these companies also end up taking a big chunk of the financial system's lending capacity, which leaves less room for newer or smaller players. You can take the steel industry as an example. A few firms effectively control domestic pricing. So when auto component manufacturers want to export their products, they end up relying on expensive Indian steel, which makes them uncompetitive in international bids. And then comes the regulators, which make things even harder. See, many Indian firms cite corruption, customs delays, complex permits, and poor tax administration as some serious obstacles. But instead of really helping businesses grow, our systems in many ways are actually slowing them down. From the perspective of a business, labor laws, for instance, create huge compliance burdens for companies as they grow, and this discourages formalization as well as scale. And as a result, businesses stay small and informal, where they miss out on the economies of scale and global opportunities. That said though, the government has tried to fix this by setting up industrial parks, but these usually end up missing key ingredients like affordable housing for workers, reliable logistics, and strong supplier ecosystems. Because without these, industrial parks become sort of islands which are disconnected from the rest of our economy. Then there's another problem, which is the final one for now, which is trade policy. See, most countries that succeeded in manufacturing did so by deeply integrating into global trade networks. They signed free trade agreements, they reduced tariffs, and also adopted global standards. But India, on the other hand, to be honest, has largely chosen to remain outside of this. We've largely stayed out of big trade blocs like the Regional Comprehensive Economic Partnership or RCEP, and even our bilateral FTAs tend to be limited as such. And this, of course, makes it very hard for businesses to access global markets and also raw materials. And this sort of inward-looking trade policy has to some extent cost us in some places. Apple, for example, is looking to diversify away from China, but its suppliers still prefer Vietnam, where tariffs are low and trade networks are robust. And even with production-linked incentives in place, Indian firms find it fairly harder to compete. So all of this paints us a very clear picture that India is not held back by a single issue. We are held back by the way all of these problems sort of stack up on top of each other. High tariffs choke supply chains, poor regulations add delays and costs, limited trade access shrinks global demand, dominant firms restrict competition, and so on and so forth. Now these issues sort of feed into each other and they form like a complex web of sorts that sort of holds back all our potential. The paper that I was referring to suggests that there is a way out, but it will not be easy at all. First, we need to bring down our tariffs on intermediate goods. That would immediately make our businesses more competitive. Second, we need to sign more meaningful free trade agreements that focus not just on tariff cuts, but also on quality standards. Third, we need to seriously rethink our regulatory approach, including labor laws, land reforms, and credit access. And finally, we also need to improve how we invest in research and development, tying incentives to actual outcomes rather than handing out subsidies with absolutely no accountability. The thing is that we've missed out on the earlier waves of globalization, including to some small extent the China plus one strategy. But the truth is that obviously not everything is lost yet. Some Indian states like Tamil Nadu have shown what is possible with the right mix of policies in place. And over the past few years, we have made progress in areas like logistics. But that said, things ahead are going to be obviously very difficult. There is no quick victory here for us, only a lot of quiet and unglamorous work that all of us in the country will need to do. And if we do not do it, we will keep celebrating these symbolic wins like overtaking Japan in GDP, while the real opportunities quietly pass by us. That brings me to the end of the two stories of the day. On that note, let's move on to the final section and talk about the quick news headlines. First, India's market regulator SEBI has restrained 5 senior executives of IndusInd Bank, including former CEO and deputy CEO, from trading in securities over alleged insider trading. According to SEBI's interim order, these officials sold shares while in possession of unpublished price-sensitive information related to accounting discrepancies, avoiding a combined notional loss of 19.7 crore rupees. Second, BP PLC is exploring the sale of its global lubricants business, Castrol, in a deal that could fetch between 8 and 10 billion US dollars. This move is part of BP's broader strategic realignment as it pivots away from hydrocarbons to focus on clean energy initiatives. That's all the news and stories I have for you today. I hope you enjoyed this show. This is your host Anurag Bansal signing off. Take care and goodbye. Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.